Good morning, everyone. Thank you for joining us. To those in Asia, or good afternoon to some of you. I just wanted very quickly to recap the earlier presentation. So the fantastic insights that came in from our Director General, Dato Daniel Ma, with regards to the performance of the jurisdiction thus far, and also that very insightful one-on-one chat with Dr. Kolshak about COVID-19, what we can expect in 2021 and the challenges ahead. So, I guess we've come to the panel discussion for the Asian Captive Conference. Again, thank you for joining us, and I'd like to personally thank our friends at Parima for allowing us to be as part of their Resilience Week. It's been a fantastic week of sessions that we've had, a whole week of risk management related sessions, and it was really fun coming in and out during the week, listening to all the insights from the global CEOs that our friends at Parima have managed to secure. So today, and at this moment, I'd really like to also thank our panel, Ariel from Marsh, Tom from Swiss Costco, and our good friend Malcolm from CWC in Guernsey. Really, sometimes when you look at the situation that we've had this year with COVID and the challenges, there's one thing that I personally enjoy about the year is the fact that we are just also resilient. It is amazing to see everyone come together, whether it be helping the frontliners or helping people with COVID or just getting our act together in trying to stem this virus and also trying to make the best of a situation. I mean, if we had actually physically hosted the Asian Captive Conference, you would not be able to hear from some of us here today. Right? So really make the best of the situation. It is the fighting human spirit and it's fantastic. So let's start talking today about self-insurance. Okay, so we've talked a lot about COVID thus far, this whole week, part of Resilience Week. We've spoken about the challenges brought by that. But let's talk about the uptake in self-insurance. Let's talk a little bit about the approach that a lot of corporates and risk managers are now taking towards self-insurance. And really, is it the coming of age for self-insurance and captives specifically? And the first question I'd like to pose to all of you actually is, has COVID-19 and the pandemic really created this perfect storm for self-insurance in the mature markets, but even more so in the more nuanced, newer markets like Asia? Tom, would you like to start?
Yes, thank you, Farah. I think excellent question. I think yes, absolutely. Perfect storm. And the reason being that actually uncertainty, economic turmoil, political turmoil has been here already before. So 2019, for example, things have started, right? And with the incoming of now this pandemic and COVID-19, it has really gotten into, one of the worst situations we probably ever had with respect to not only the economy, but also, and the economic impact, but also the insurance market. And that's why the concept of self-insurance, certainly, while it has developed very strongly over the past 20 to 30 years, it's now at the stage where it has the chance to become really mature and really established.
Ariel, do you want to weigh in on that? Do you have any specific thoughts on whether, the Asian uptake is a little bit different from the global take-up or?
Yeah, maybe I can offer some local observation for the Asian market. So I think compared with the mature market like UK, US, our perception for risk management is still at the very early stage. So based on that, I think this is a perfect opportunity for clients in Asia, for companies in Asia to realize the true value of self-insurance or captive, to show them, how captive can help you in this difficult or uncertain time.
So, and is that what you've been seeing with your clients, potential clients, about them being a bit more open to that concept of owning
Yeah,
entity like a
previously
captive?
we are in a good track. We are going up. Economic is good. Everything seems bright. But now we have some obstacles on the way. So I think the obstacle has a value that is this obstacle will brings you mind to see, okay, what's the true value of something you probably not pay much attention in the past.
Yeah, thank you. And Malcolm, you famously always tell everyone, especially you, every time we talk, you're always like, well, I've seen lots of hard markets, and and you know, this one's just another one. But really, no, this one's just not another one, is it?
Well, I don't know. I think there's been some pretty hard markets in the past. I've got a number of observations. The first really aimed at the insurance market itself, and I think what's happened out of the COVID-19 is it's increased the amount of uncertainty as to the value of insurance purchased. If you have less confidence that your claim's going to be paid, then I think you're more likely to look at self-insurance as a solution just because of that more sustainable claims payment process. And I think what's happened is a lot of the very large entity companies and the banks have decided to self-insure because they just feel that that gives them more certainty. And the question is whether other organizations, not quite as large as those, will also take that same decision. So I think in a way the challenge to the insurance market is whether they can make sure their policy wording is fit for purpose and actually meets the particular needs of the client. And that's not a new issue, but I think it's just come out more now, given the sort of business interruption claims that we've had under COVID-19. In terms of the captives, I mean, I think there will be a bounce that people will move to self-insurance or captives or other vehicles just because the market is so tough. The question really is what happens in 2 or 3 years' time if the market starts softening again? Was this just a tactical move to get them through that particular issue, or are they going to take a long-term sustainable view in terms of having a proper thought out risk financing strategy and use a captive really to be part of that strategy?
So for you, is it like a given? Okay, so having a captive is a given, but do the risk managers and the insurance industry, will there come a time where there's stamina to continue with the self-insurance?
Culturally, it comes down to, I think, whether you're looking really to make tactical buying and really arbitrage the market, or whether you want to have as I say, a robust risk management framework in place that gives you much more resilience, whatever the market is doing. And culturally, I think Asia has maybe looked at this slightly different, so say from the Americas or Europe, and that I think is going to be the challenge. What I will say is that a lot of organizations, once they have a captive and they get used to the value that the captive generates, in terms of giving them good governance of their risk, in terms of good reporting of information, in terms of being able to consolidate risk. In many cases, they decide that those values outweigh any short-term arbitrage benefit when the market's soft. So I'm optimistic that captives will keep growing, but we won't really know until 2 or 3 years' time.
Yeah, no, it's interesting to look at the Samsung captive and how that has helped Samsung Re actually turn a corner this year because of all the profits retained within that Samsung captive. That's exactly what I think an example of what you're talking about. Let's look a little bit about the drivers, right? So Marsh came up with a report recently about the captive landscape, right? And some of the numbers in that report, like, mind-boggling, really mind-boggling. The kind of percentage growth that you've seen, and also the kind of business that's being put through it, the kind of, how hard the market is really for certain lines, but also, the growth, the potential growth anyway, in the medium industry, right? So the large jumbo, what they call jumbo captives, is that what the term that was used in the report? That's fine, so that will stay. But then they've got this medium-sized SME type medium captives that has seen like is it a 300% growth in interest or 300% growth in actual incorporation? You know, and personally, I call that the commoditization of captives, because everybody thinks that it has to be, you know, you have to have such a huge number of premiums in order to own one of these vehicles. But actually, you may not. Do you want to walk us through the report a little bit, Ariel, and talk us through, you know, your thoughts about how do you see this landscape moving?
Thank you very much, Farah. It's my pleasure to work everyone about the key findings in our report. In this year, we delay our report on purpose to September because we want to capture the pandemic-related information, make it more related to everyone. So at the opening of our report, we listed the challenging ahead all of us, the entire industry of insurance. So as we can see, the pandemic brought a difficult time to many industries, especially the hotel, restaurant, and retail business. Like here in Labuan, I saw those hotels on this island are struggling for their business right now. So their revenue dropped, and meanwhile, you have to pay extra expenses to keep the operation running. For example, for inventory loss, inventory waste, and for retail business, they are trying their best to convert their operation into e-commerce that require extra expenses. So the time is quite difficult for everyone. And on the other side, we are facing the hardening market. And according to our global insurance index, the price of premium start climbing up since the last quarter of 2017 and till the second quarter of 2020. The quarterly growth rate reached 90%. And it will last for the next 12 to 18 months. So we are still having some time before we saw the softening market coming back. So under this such difficult and uncertain time, I think captive can still offer some values to everyone. So I summarize these values into 3 C. So the first C is cash flow. So because captive is a risk financing vehicle, you have the policy surplus accumulated in your captive book. And at such a difficult time, those fundings or those policy surplus can support parent company's business. And the second C is coverage. So under this unprecedented time, at least based on my timeline, it's very difficult time for many companies. You could not get what you want, for example, the business interruption coverage from the commercial market. And you probably could not find the ideal wording you want. And the retention is going up. So captive can help the parent company to provide, to tailor-make the coverage to cover the true needs of the company. And the third C is care. I think, including me, everyone under this time feels so stressful. This tiny little RNA virus change our behavior pattern, change how we connected and how we communicate. Like today, we communicate through the Zoom. So under this pressure, I think captive can help companies to show some care for their employees. For example, employer can use captive to provide extra coverage for the medical cost, for the days you can stay in the hospital. That's something can release at least a tiny little pressure from everyone's shoulder.
Yeah, did you want to talk a little bit about this growth of the mid-sized captives? Because I've got a quote here that says over the past 5 years, mid-sized captives have seen the most growth from 11% in 2013 to 23% in 2019. So where do you see that moving forward? And what kind of structures do you see being used for mid-sized captives?
Mid-sized captive, I think, is more flexible compared with the larger one or the small one. The small one, they don't have enough resources to, for example, they want to tailor-make some coverage, want to add new lines. Probably they don't have the enough capital to support this idea. But middle size, they have enough capital. They have they have the enough capital to support the additional line they want, and also they are more flexible with the strategy. So growth of I think growth of in middle size captive will last. And larger ones, we all know the large company are facing the same problem, that is very difficult to change your direction. You have
Okay.
to you have
Yeah.
long decision.
Yes, Malcolm.
Can I add a fourth? Can I add a fourth C, which is capacity? And I know in the past people have said, well, captives don't create capacity. But actually, looking at the Marsh report, I thought it was fascinating that the capital and surplus of the captives under their management is $113 billion. Now that represents by number about 20% of the global population of captives. But I'm assuming that they are going to tend to be the larger captives. So I've extrapolated that to be a total capital and surplus for captives globally of $350 billion. Now, it's estimated that the global annual spend of captives is about $150 billion. And you can see that's a very conservative underwriting. I mean, it's capital exceeds premium by 2 to 3 times. If the captive owners started leveraging that capital and surplus, so that they were actually writing to the capital and surplus and the premium, add them together, you end up with $500 million. Now that to me is a significant amount of capacity. And captive owners traditionally are very conservative in their underwriting. But I think maybe given the current environment, it may encourage them to just leverage their capital and surplus a little bit more. Where it gets really interesting, if you said you really leveraged the capital and surplus so that you were writing, say 3 times premium compared with your capital and surplus, which maybe a commercial insurer may do, you actually get to over $1 trillion of capacity. So there's some quite interesting numbers in there, and I think Marsh's report starts quite an interesting debate.
No, it does, and it's quite interesting to kind of think that if all the captive owners got together, that's a bit of a force to reckon with. Tom, you wanted to say something.
So I wanted to add my 2 cents to Malcolm's comments, actually to the one just now and also to the one before, because Malcolm, you said you're optimistic about captives and the concept of self-insurance. I would even go a bit further. I would, as I said in the beginning, I think it's now the time to really establish this concept much wider in the market, and there's some evidence to that. First of all, with one thing we know, right, is that change is part of our world. And I think what has changed over the recent past is that the amount of change has ever increased per time unit. And that means you have a lot of new risks coming in out there in the market on not a daily basis, but basically over time. And what self-insurance and captives can offer in addition is that they can take on new risks coming up much more flexible than the commercial insurance industry can. And that flexibility is a benefit, especially in times when the changes are dramatic. And to your second point, Malcolm, exactly, that's the evidence, right? There is enough surplus around to actually also take over these risks. And the possible leverage that is still out there for captives is tremendous. So I would assume that in the next future, in the near future, we will see not only risks like pandemic risks or non-physical damage BI risks being much more taken over by the captive, but even in areas where the whole insurance industry is not really good yet. So, for example, cyber insurance, right? Captives will take a much, much more prominent role. That is my view.
So what I'm getting from this conversation is twofold. Number one, it is a perfect vehicle for unique risks. Number one. Number two, it's also a great opportunity. It's also used as a retained profit center, but also, in a way, captives will force the insurance and reinsurance industry to re-look at its operating model to a certain extent.
I think Tom's right in terms of this idea of the captive as an incubator, if there is a new risk. I mean, I think what we've seen with the COVID pandemic is that we now realise that a lot of risks are much more interdependent and interconnected. And if you work through the pandemic issues, you've got the cyber risks that have happened, people working from home, a lot more fraud going on. You've got the social discontent and the political instability. Supply chains are having challenges. You've obviously got the business interruption, non-physical damage issues, and a little bit as Ariel was talking about, there are going to be some mental health challenges coming out of that.
Oh yeah.
Now, I suspect that your traditional insurance policies aren't going to pick up all of those risks and also the interconnectivity. And I think the captive can play a role really by providing some sort of difference in conditions, different in limits cover that basically picks up the gaps which the traditional coverage cannot respond to. So it's a bit of the old Swiss cheese analogy with the holes in the Swiss cheese, which the captive can fill in. As you gather more information, then either you can have a better attempt at pricing that, and therefore the traditional market may be more interested in providing a comprehensive cover.
Right. But I'm a bit altruistic in the way I look at things, right? And it's all well and great if you have a large company, but if you have a tiny company or mid-sized company, you shouldn't be denied access to this wonderful thing called self-insurance, right? So maybe this is where I want to bring in Tom a little bit and talk about his captives on training wheels or floaties, maybe your virtual captives, and how that might be able to assist, because really, and as you can see, what I'm trying to do is discuss the ability for medium-sized companies to also have access to this, because number one, Ariel's report clearly shows that is the biggest space, and Malcolm's clearly describing universal risks. These risks that Malcolm's describing doesn't belong to large companies alone. It belongs to you and me and every single entity, and everyone should deserve an opportunity to mitigate that risk. So maybe Tom, talk us through a little bit through your virtual captive, and how it might be able to assist smaller entities as well, whether they be in Asia or anywhere in the world, really.
Yes, I love to do that. I think one thing I would want to say first, it's not only or exclusively for small and medium-sized companies. It's basically for all companies who have decided that the self-insurance concept and particularly the captive approach is what is the right thing for their needs. So this is the decision they need to take. And it doesn't matter whether it's small, medium-sized or large-sized companies. And we have basically, what we've done is mid this year, 2020, we have thought about all these companies out there that are currently considering, establishing a captive, but maybe don't have the time or are basically, or are maybe trying to avoid the cost of setting up a fully fledged captive, or they have concerns about maybe later exit options when you establish a PCC or a captive. And for all those, we have thought, why can we not provide Swiss Re Corporate Solutions balance sheet to imitate or emulate the the financial mechanics of a captive, right? We cannot imitate the rest, but we can imitate the financial mechanics of a captive. And that's what we're trying to do. So instead of asking a company to set up a captive or to enter a PCC agreement, they can come to us and say, we would like to enter a multi-year structured insurance agreement, which has some structural elements in it, but apart from that, it's a simple insurance agreement, which then makes the whole construct a self-insurance construct. And this is essentially what the virtual captive is. So basically, you emulate the financial mechanics of a captive, being self-insurance, with a structured insurance agreement on our balance sheet. Now, what is important to keep in mind is at the moment, the most demand that we see is for those companies who have decided they want to establish a captive or a PCC, but they just don't have enough time now, and they have other priorities. And for them, it's a bridge, right? They want to start with the self-insurance concept as soon as possible. And for that, such a structured insurance agreement is perfect because there's a relatively speedy implementation to that. And then you called it a floaty, Farah. This is maybe a good expression, right? It's also for some, it's also a test, right? Let's test the concept of self-insurance. Does it really deliver what we are hoping it delivers? And once we have gained this experience, we can then still decide how to move forward. And this is what it is for. We have currently tremendous demand on that. And we believe it is, if you take a step back, and just as a last remark, I think, if you take a step back and think about it, it is a natural consideration that you try to use an already established infrastructure out there in such a complex regulatory environment to do what you need to do, right? Instead of creating a new legal entity in a complex environment, you can defer that to a stage when you're ready, and you can start with leveraging an already existing infrastructure. And that's basically what attracts many clients at this point.
Okay, so I like the idea. I think it's fantastic. My only question is that, would there be an over-reliance on the provider? Malcolm, what do you think? Like, do you think that, it gets to the stage where it's like, okay, let's just leave it all to Tom and he'll sort it all out. But that isn't necessarily the ethos of a captive, is it?
Well, it could be just the incubator model again. First of all, I commend Swiss Re and Tom for coming up with this idea, because I think it's a great example of a partnership between the insurance industry and the clients. Because in some territories, when you start talking about self-insurance and captives, the local market gets nervous because they think that they're actually going to lose that premium spend.
Yeah.
I think what evidence shows is that actually the captive or the self-insurance sits very well with the traditional insurance placement. And in fact, the insurance spend will be the same in traditional insurance. It's just that you'll be able to buy more insurance. And also you'll be moving the insurance market away from the volatility of the first losses. So it's actually a win-win, but I think there's a certain amount of education that may need to go on. And for an organization as sophisticated as Swiss Re, they understand the value that they can offer with that. I think we just need to share that knowledge with a broader base of insurers.
I see. And do you think this is, and I'm opening this up to all, do you think this is kind of like an evolution of the concept of a captive? So it gets to the point where it's a little bit less proprietary, but still very bespoke, right? Do you feel that this is how we're going to move forward with the demand increasing, with the hardening market and all the rest of it, with people understanding the benefits of it, do you think this is how, soon everyone can have a captive? I don't know. Anyone want to start?
I'll start. It's definitely a way forward. It's definitely a toe in the water. And like most things, we've seen this before. I think the French insurers were using a similar model back in the 80s and 90s, although the accounting rules have changed a little bit since then. Yeah. That there are also the option of sales in PCCs. And what I'm also seeing at the moment is cohorts of smaller companies getting together to talk about forming a group captive or a mutual, and that way they can get the scale and the bulk purchasing. So I think there's a number of ways that you can look at it. The other thing that interests me really is the partnership between the insurance industry, and governments, and what we've seen is a number of sort of last resort reinsurers being set up by the governments. We had TRIA after the World Trade Center, and now we're talking about PRIA in the US, which can be accessed by an insurance entity into the government-backed reinsurer. There's no reason why a captive wouldn't be able to access that. So again, that's a way of creating more capacity and maybe just keeping a small amount of risk in the captive. Going back to the 80s, some of us will remember in the hard market there that companies like ACE and XL got formed as mutuals, where a number of industrial companies couldn't get the cover they wanted in the marketplace and created their own capacity. So there's lots of things you can do, and sorry, the last thing I think that may happen with existing captives is there'll be demand for legacy services to basically sell off your earlier liabilities so that you can free up your balance sheet and then create the capacity for going forward.
Okay, that's an interesting idea. So kind of like a yes, okay. And that's true, I mean, that's what we're seeing. We're seeing in Labuan, because we have the protected cell company structure and mutuals and association captives. We're seeing industry come together, to try and figure out, okay, so we've got a mutuality of sorts, whether it be an industry or whether it be a shareholding, or, for us to come together, maybe net off some risks and then really go to market with a cleaner piece, to try and get some cover. Ariel, sorry, Tom, yes.
Just maybe to finish on the virtual captive question. So I would see this as just another tool that you have available. So you were asking about, is this a development? In my view, it's one of the tools, and it just adds to what a client does have available. So in terms of self-insurance concepts, and that's basically what it is.
Yeah, but I think what's interesting about the virtual captive is that you're putting in a multi-year line, right? So that kind of gives some, it gives comfort also, right? So you set up a captive, okay, but this creates that comfort of having a multi-year line, especially in a hardening market. Some of these things have gone up 200%. Some of these covers, right? So I think that comfort is something that I think, as Malcolm is well, if I understand Malcolm correctly, is because I struggle. I'm not an insurance professional, so I struggle sometimes trying to grasp the idea. But it's almost right. Okay, so you have the structure. So we have mutuals, we have sales, we have all the rest of it. But what the virtual captive actually does allow is this multi-year comfort, right? Because of that hardening market as well. And then you've got the backup of that balance sheet of Swiss Re Costco. So that's something else. Ariel, I wanted to bring you into the conversation a little bit and talk about when we look at Labuan specifically, right? Mm-hmm. And all the different types of structures, we know for a fact in the first half of the year, out of the 7 new captives, 5 were protected cell companies, right? Yeah.
Yes.
Where do you see that moving forward? Do you see Labuan really coming onto its own, not just as a captive domicile, but as self-insurance domicile?
I think maybe a few products will be the growth point. The first one, I think, is extended warranty. Because in Asia, lots of companies already started the conversation regarding selling the service to the customer or to the vendor. So that means the client has already have perception for this layer of service. So they want to maintain the good relationship. They want to increase the loyalty of their customer. So we have prospects in the market, and so right now.
But can I just ask through which structure specifically? I mean, what you're looking at is the kind of risk or the aggregation of that risk. But what kind of structures within? Because Labuan's got a lot of different structures, solutions within that self-insurance. So if you were going to do what you mentioned, like cover that risk, which structure would you use? Which structure are you recommending to your clients?
I think PCC would be the feature for the Labuan because this is the only place with the PCC lesson. And for the reason is PCC allows you to test the operation of a captive with smaller captive. So the error, if you make some mistake, you want to withdraw, the cost is limited compared with the formal captive. I think that's very good point for someone who wants to try the concept of captive or self-insurance. And the other thing is considering the substance requirements everywhere in every domicile, PCC would be a good choice, a good choice to save some headcount cost for the client.
And
as
of
well.
course, you can always migrate one of your cells into a full-fledged captive anyway. So when you're ready. So I think we're going to come to the end of the conversation here, and we are 13th of November today. Not very many days to Christmas. Not very many days to the end of a very, very long year. So I need to ask that crystal ball question, right? I need to ask all of you what your thoughts are for 2021. Where do you think the market's going to be? How do you think we're going to continue to react to this pandemic that shows no signs of abatement? And how do you think the reinsurance industry will react to a surge in self-insurance and an even deeper hardening market? Any volunteers to go first?
I can go first. So, crystal ball, right? I'm not sure whether it really needs a crystal ball for a couple of basic assumptions that, in my view, are just clear. And the first one is that this pandemic is not going to go away within the next months. No, certainly not until Christmas, and probably not long into 2021. So this is staying, and that means the uncertainty also economically as well as on the insurance market with respect to capacity and prices will stay. And that clearly means that also next year, 2021, we will see, in my view, an even higher surge of companies looking at self-insurance. Reason being, they all go through the really, really difficult renewal seasons now, right? 1/1, 1/4, 1/7. And once they went through that, they will sit down with their, probably finance departments, probably business unit leaders, and they will start to think, right? What can we do better? And self-insurance is one of the options on the list.
So, Malcolm, Tom says it's not crystal ball, it's writing on the wall. What do you think?
I think I must be reading the same writing on the wall as Tom. I'm not an insurance or reinsurance market expert, so I accept what Tom's saying. I think that you will continue to see interest in self-insurance. I think it will percolate down to some of the companies that previously thought they were too small to consider captives. At some point, there will be more capital coming into the marketplace when it becomes just so attractive to enter, and hopefully that will create some opportunities. But it's I think 2021 is going to be similar to 2020.
Maybe a little bit better. Oh, maybe not. Ariel.
Yeah.
What are
Okay,
your
so-
thoughts, Ariel?
Okay, since it's a crystal ball question, maybe I use two words to read the future. The first word is ticket. So self-insurance or captive is like buying a ticket for you to get into the industry of insurance. Without this ticket, you can communicate with all the players in the market, but your role will be the customer. It's different. And with self-insurance or captive, you are one of the players in the market. So you have at least a voice in the market. Not very loud at first, but you have a voice. You can communicate your thoughts, your strategy. You think about capacity with those players, with those capitals in the reinsurance market. So that's the first words. The second word I think is a reservoir. So reservoir built to collect the water. When you have the nature disaster, we can have actual water to supply. So same thing here for the captive. So captive here at this difficult time could be used as a reservoir for your cash flow, for your capacity that can provide something to support your business in the future. So I think that's something we can read for the future.
I love it. It's fantastic. So a ticket to the big table and capacity, just the ability to have access to capacity and to grow that capacity within your own control. It's fantastic. Thank you very much, all of you, for being part of this panel. Thank you, everyone, for coming to the Asian Captive Conference. We hope to be able to host this live next year. Or maybe have a hybrid event. Actually, I think that's one of the things that will be fantastic going forward is that we could have a hybrid event where some of you, we could meet some of you in KL, Kuala Lumpur, and some of you will be online, and it'll just be a lot more accessible, as it were. There's nothing left for me to do but just to thank everyone now, the panel, thank everyone for joining us today, and we hope everyone stays safe. And that we'll be able to see you in the flesh soon. So thank you very much. Have a fantastic evening. Thank you.